Thank you very much. So we'll start this next session. My name's Milford Bateman. I'm based mainly at the University of Pula in Croatia, and I have an appointment at St. Mary's University in Halifax in Canada. My background is on local economic development and sort of moving into looking at the issue of local finance, because that's a really important aspect of local economic development, which is where I came into contact with many of the people organising this event, for which I thank them for inviting me. What I was brought in to do was to really bring the, as far as I understand, to bring the discussion more towards, what alternatives financial systems and financial institutions are we looking at? That perhaps bring back in the idea, which really is the whole point of the conference or the seminar, is to look at development. So if we're trying to connect finance to development, have we got the institutional architecture right? Are the institutions that we have around doing good? And is this new fintech model, is it on the right track to doing good development, or is it simply a way for some savvy entrepreneurs to make a shed load of money? So I think we have to look at that. My take on the issue is I feel there's a bit of deja vu. It's a bit like in 1990, if we were sat here talking about microfinance, there would be a lot of discussion about the potential, and it's going to do this and that and the other. And, well, we've all been disabused of that notion. So all the talk about fintech and all these new models, is it really about development? Where do developing countries, the global south, come into this? Is this model really going to connect with the everyday experiences they have? And if not, then what alternative models are available? And that's why the panel was put together, because each of them in their own way has some sort of an alternative model to the traditional, I suppose you could say, the traditional microfinance model. They have alternatives and different perspectives on it. So we thought it would be good to get them together to add a little bit of another dimension to the discussion on fintech and all the other things that we're discussing. So I will start, first of all, then with Gert, who is going to talk about issues in Germany and
on a European scale.
A European scale.
Can I? Yeah. Okay, when you talk about development, so I would like to emphasize, since the Sustainable Development Goals, we understand that we not only need to develop the global south, we also need to develop the global north. And when I say develop the global north, I mean very much develop our consciousness, the mindset that we use when we look at business. Let me ask you all a question. When you look at a company, when you would like to hand out a loan to a company, would the institution or the context that you work in, would you emphasize just the economic viability of a company, or would you also look at issues like sustainability, ecological themes, ethics? Can I have hands? Only economic considerations, also sustainability considerations. Okay, thank you very much. I would like to underline, not so bad, exactly. I would like to underline this approach. Could I have the slides that you already showed me? So, I talk to you as a representative of an initiative that is called Economy for the Common Good, or Common Good Economy. We posit that an organization with an economic viability also should adhere to values, humanistic values, like human dignity, solidarity, sustainability, social fairness, and democracy. And why do we believe that these values are important for business? Because these values are enshrined in our democratic constitutions. And through a long struggle of mankind, we have come to the conclusion that those are values that we would like to create the welfare of a nation upon. That is why we posit that business should adhere to the same value, to the same set of values. And economic results should only be achieved within observing an ethical frame. That may sound a little bit idealistic to you, but what I can show you here with the common good matrix, I'm sorry, my mistake, I put the German version in here. Very sorry. But what you see is that on the horizontal, we have values like human dignity, solidarity and justice, ecological sustainability, transparency and participation. All of you now have a crash course in German, of course. So we measured, what you see here is a matrix, which is the foundation of a balance sheet. We offer companies this matrix, a set of questions, and a description of first steps and best practice. And a company assesses themselves according to their contribution to these indicators. And that is how we are able to score companies' contribution to all the members of their value chain. Like on a vertical, you have suppliers, you have owners, you have employees, customers, and society at large. So we have created this system whereby a company can evaluate themselves, and then we come with auditors, and then it will be published. Currently, 400 companies have come up with this balance, and we have several thousand companies being influenced by this approach. And we have also started a banking operation. Since it's pretty difficult to get a banking license, we have established it as a cooperation, a co-op. We have 5,500 members, and we have so far put up 4 million euros in funding. We have 40 projects under view and just one project financed. And you can see that this is the very beginning. And the lines of business that we would like to cover with this bank is crowdfunding, crowd giving, crowd investing. We have an academy that spreads the ideas of ethical economy, common good, and we have a payment facility. We would underline this is boring banking. That is not high-level credit default swaps stuff. This is taking money from customers and putting money out to companies in need. And our special approach would be that everybody who wants funding from this bank would need to go through look on the right side, look on the common good. Every project needs to demonstrate their contribution to the common good alongside the matrix that I just showed to you. Thank you very much.
Okay, I think there's a lot of initiatives, I think, working along the same lines. I think in microfinance you have social performance management, which is about it works on the assumption that the companies or the microfinance institutions don't really know what they're doing to maximize the common good, but in actual fact they know exactly what they're doing, and they don't need to really be told a set of guidelines. They know exactly what they're doing, and in many cases it's not in favor of the common good. We also have, somebody mentioned earlier, something like Uber as an organization that is on the good side, but in actual fact they've now banned it in London and hopefully in many other places, because it's really going to, of course, we're very interested in inequality now after Piketty came out with his book and it was a global bestseller. And institutions like Uber clearly add to the whole inequality angle by informalizing the market and the race to the bottom and stuff like that. So how could you, in your organization, what guarantees that these companies come with these great guidelines and tick all the boxes? Is there any follow-up from you in terms of, are they sticking to what they said they were sticking to? Are the regulators charged with doing that? Or how do you keep these guys to the good things that they say they're going to do?
Well, the instrument is the publishing of this common good balance sheet. And we have currently, as I said, 400 companies coming up with this balance sheet. and there is a follow-up process. We recommend a company reduce their balance sheet every 2 years, and that is actually happening. And we see big developments, big improvements in companies on different levels. And the companies who use that are mainly small and medium companies. So I would say maximum number of employees is about 1,000 to 1,500, but the bulk of the companies are in the level of 50 employees. And basically it's an initiative based on the insight, the awareness of the owners of those businesses. And our strategy is to get as many companies sort of under our model, draw them into our model, and show that ethical business is viable even in a market economy with under the constraints of competition. And many of the companies who work with us are already 10, 20 years in the market and are successful. So we can prove that ethical considerations are compatible with a capitalist economy. It can be done, but it's a voluntary step. It's a voluntary investment, so to speak, from the owners. And it needs to be followed up by a framework that is transparent and allows for societal implication.
Are you saying also that the companies that come to you were not generally aware that there was a way of working sustainably and ethically and yet successfully commercially, or that they were resistant to it and you somehow overcame their resistance? I mean, it seems to me it's a bit like a lot of the MBA programs. They now have, for example, at Harvard, I think they have an MBA program on ethics. And you would think, well, you know, these guys are the creme de la creme. Why don't they know about ethics already? Is it something you need to be taught, the difference between right and wrong? But so, I mean, is it that they don't know what's the best, or that you're overcome it? They know what's the best, but somehow you overcome their resistance?
Well, the standard approach to business is very much focus on profit and focus on advantages for the owners. And we transcend that limited approach to business. We emphasize that consideration for your supply chain, the ecological and democratic qualifications of your suppliers, how you treat your employees, the quality of information that you give to your customers, think VW diesel scandal, and what you contribute to society, that is important. The fact is that most businesses that decide to work with us already understand that. So in a way, we work with the people who are already convinced, but we believe it's very important to bring everybody who has a notion, an awareness for this concept that economy can not only focus on profits. It's necessary that we bring them all together and create an organization that becomes a viable voice in the public discourse about our economy.
Okay, that's very interesting. That's a great introduction to the sorts of challenges that the financial system has. So we'll move on to our second paper now, and Paolo Dini will take over.
Okay, hello. Thank you for inviting me. Very interesting to be here. What I'm going to talk about next is actually very closely aligned with the first speaker's comments. But I should first mention that I'm wearing two hats. I'm here both as a consultant for Sardex, which is the empirical case study or the example, the practitioner example that I'm going to describe, as well as an academic with some sort of analytical perspective on what's going on. And so from that point of view, in thinking about this morning's remarks in the first session, I can say that lending is indeed useful to entrepreneurship. And alternative finance is an innovative way to improve on that and to think of new ways of doing it. In addition, from the point of view of the dependence creation, lending is better than charity giving. However, the problem is that there is still a power differential between whoever has the money and whoever is receiving it. So the, I guess the more radical innovation is to distribute the ability to create the funds themselves to the people who need them. Now that sounds a little bit strange. Margaret Thatcher said money does not grow on trees and so forth, but Bitcoin has already disproven that point of view, right? So indeed, Bitcoin and similar examples are showing that you can create money without, in defiance to the authority of the state and the power of the banks. However, Bitcoin was actually not the first way to do this. As Georgina said this morning, the people, almost half the people in the world are based on some sort of mutual credit type of economics, where you keep track of who owes what to whom. And there was a question this morning about, well, isn't that just barter? And a reference was made to about 2,000 years ago. Well, actually the figure is more like 5,000 years ago. The Babylonian times, people used to have a credit-based economy. That was about 3,000 years before money was invented. So, and it was not barter, unlike what Adam Smith said. This has been disproven by many anthropologists in the last century. So, multilateral barter is actually not barter, in the modern incarnation of that is mutual credit, and Sardex has somehow brought together these ideas in a system that appears to work remarkably well. I press the green button. It's not working. Okay, so I think that one thing we have to somehow make our peace with is that Bitcoin has actually popularized the idea that money can be designed to have different properties. So what properties could it have to be useful for sustainable development? And I define sustainable development, similarly to what Gerd just said, as a stable and constructive integration of market activity with democratic institutions. And on top of those you have, or below those you have the values and so forth. So I like to use this diagram to somehow make a bit of order, put a bit of order into the wide variety of monetary systems that we're witnessing. So we can have the capitalist system and the commons-based approaches, and libertarian versus state-centered approaches on the political side. Bitcoin is anarcho-capitalist, it's libertarian. And the Sardex is roughly on the hovers around the lower right quadrant. It has an interface to the state through tax transparency, but it is somehow a combination of commons and capitalism. So it's a complementary system. Sardinia is a poor region. It actually, as was mentioned, I think correctly, many of these examples of complementary currencies spring up in times of credit crises. This is the Sardex network a couple of years ago. And here's some basic facts. 7 years and running. Was created in response to the financial crisis. 3,500 company members. It's a B2B system. Transaction volume is very small, as was mentioned already this morning. 0.3% of the island GDP, which is itself about 2% of Italy's GDP. And it's in 2015 it was 51 million euros. In 2016, 67 million euros. So I'm talking about euros and credits interchangeably because the credits are pegged. It's the same unit of account. And there are different properties here that we could discuss, but the main point is probably is that it's zero interest on credit and debit balances. And the total tax transparency is extremely important to build trust with the state. And it's based on yearly membership fee, which gives it economic sustainability. As you may know, mutual credit is based on zero balance of all, zero sum of all the balances, positive and negative. And it works like this. If you have a buyer and a seller, the buyer has no money. Money is created at the time of the purchase. And this sort of underlines the sociological monetary theory perspective that money is a social relation of credit and debt. So the next point is really to say, okay, integration, the values and the integration with democratic principles is important for sustainable development. Let's say that it is necessary. Is it sufficient? I don't think so. You need to have a stronger governance framework, which is an area where we are, it's sort of at the frontier because there aren't that many examples that actually implement this. This is just to show that the back-end, which is the spare capacity of the circuit, all the products and services that are used to justify going into debt, is about 20 times the monetary mass. So 20 times the amount of debt, which is the opposite of what happens in a speculation bubble. So that's nice, it's stable, but some systemic problems arise over time. And in particular, you have non-recoverable debt, like bankruptcies. You have free riders who are consistently negative. You have good members who are currently not being rewarded. You have savers who, in spite of the fact that it's zero interest, they prefer to hoard a few thousand credits, and they don't help the market because they don't spend them. And then you have importers, people who are importing goods from outside, such as heavy machinery or tires, things that are not manufactured in Sardinia. And so the problem is that they have to pay for those goods in euros. And if they sell them for credits, they accumulate a very large positive balance, and they don't know how to spend those credits. So we're talking about 200,000 credits. It's a lot for a medium-sized company. So here is a possible framework, which I cannot explain in much detail, but I can just say that the idea is to propose a co-op, which is somehow sitting side by side the for-profit company, which is currently acting as a credit clearing service. And the co-op will invest through a commission fee on transactions into solar panels, which it will use as a source of backing to essentially allow the importers to buy energy for their credits. So it gives the importers a way to spend their excess credits. And then it can use those credits to plug the holes of the bankruptcies. That's the short version. It can go into much more detail. We're working on a blockchain-based architecture in the Interlace project, a European project. And you can see sort of the workflow of the ideas from what is currently working on the left towards the new ideas on the right. Main points are distribution of social cost as new principle, distribution of ownership as a long-term goal, proof of altruism instead of proof of work, which is basically just wasting energy through CPU cycles like Bitcoin does. The right to debt forgiveness, that's an idea from 5,000 years ago, and commons, using commons as backing, such as renewable energy. So that's sort of a quick summary.
That's a very quick summary. One of the things that I think people are very worried about with these, when you raise issues like blockchain and very complex sort of schemas like that, is that, isn't it a bit of an over-complex response to a situation where in the past we used fairly commonplace institutions? And I'm thinking Germany, post-war recovery was very much helped by its system of cooperative and regional banks. Very simple organizations, very well managed, not too rocket science, but very well managed, very ethical, and really created the German economic miracle in many ways. And you could look at other countries where very simple cooperative or state banks, like the Landesbank in Germany and other countries, those were fairly simple. Isn't it a question maybe that we're overcomplicating the issue with all these things when the actual solution is right on the table in front of us, but we don't want to We don't want to pick it up because it's from the past.
Okay, fair point. There are a few things I can say to that. The first is that I will cite Douthwaite again. Georgina had his name on one of the slides this morning. He was talking about the fact that at different scales, the economy will need different instruments. And in fact, mutual credit is nice because it works well at small scales, precisely because it's based on trust and knowing each other, the social dimension. So I would say that because my background is an engineer, if I want to optimize a system, I look at the very different, at the different scales involved, and I try to optimize each separately and then the whole system as a whole. Now, what you're talking about is essentially Rhineland capitalism, which is, as we know, a gentler version of the Anglo-Saxon kind, and I'm all for it. I think it's a really good idea. In fact, the Veer Bank, which is the mutual credit system to which Sardex originally was inspired, is a cooperative bank. So it does seem like a good approach. But what helped Germany and Italy, especially after the war, was even more than the cooperative banks. It was the European Payments Union that was proposed by Keynes, which is essentially the same concept of a mutual credit, but on an international scale, which incidentally I think could help the situation with Germany and Greece today, if we wanted to push it a little further. Indeed, yes, cooperative banks are a viable way to run an economy, perhaps at the medium scale. I would say that at smaller scales, mutual credit works best, and at the national scale, I think that's still open for debate.
Okay, we better push on. And so the next, Simone, would you?
Yeah. I had some slides. I'm happy to talk about gender-based investment. We haven't talked about it yet. And not so much about lending, but about the family funds and fools, the loan sharks I heard, and venture funding. We have set up an organization because 5 or 7 years ago, we saw that the whole venture fund ecosystem was a bit broken, and especially towards women. In the US, in the meantime, they have taken some measures to repair that, and in Europe, actually, we haven't done a lot. I hope you can read this. So. There are multiple reasons why venture fund is broken. You look at the numbers, I think around 12% of early stage seed capital goes to women, and 7% of follow-up and funding. Globally, I think it's 5%. And these numbers mean that a lot of women do not get venture funding when they take risk to build companies, which means that they don't build those companies. Reasons why. First of all, 95% of the investment community and the investment funds are decided by men, and because of the community of the VCs and of the investors, the angel investments, are men. You see that the deal flow comes from their network, which are men. Men are in male networks, women are in women's networks. So that's one reason. The other reason is that there is a bias towards successful young male entrepreneurs by these investors. And there's been a recent study in Harvard that if the same plan gets presented by a guy or by a girl, that there is, I think, a 60% difference in success rate, while the plan is the same. So what you see is that on the same plan, men are about 40% or 60% more successful in getting that funded. Actually, handsome men have a 36% percentage to get more funding. So the guys who were just here, they are, in a way, the examples, and even, you build great companies, but you are the examples of the the venture of the statement that venture funding is the system is broken. So the stereotype basis is one thing. The other thing is that women are not in those social networks, and a lot of investors, especially at the beginning, they start in their own social networks and they make their references in these own social networks about these investors. So that's another reason. Another reason is that women tend to, it's whether it's a confidence or whether they are more realistic, but they tend to be more realistic about the future of their own plans, which means that they also ask less money, and that the vision towards the future is not as portrayed as such for those male investors who are used to that. So it's also a matter of education. Other things, if you look at two numbers, venture fund is not only broken towards in a gender way, but 10% of all the venture funding goes to actually Harvard, MIT, and Stanford graduates. And 50% of all the venture funding in the world goes to people in New York, Boston, San Francisco. So the system is more broken than we sometimes imagine. So this is the first thing I want to tell you about. Why does it matter? It has two components. Societal, it has a component because it means that a lot of companies which are basically thought about by women, which are sometimes women problems, do not get solved in the same manner. So you get a lot of Ubers, but you won't get a lot of femtech companies. So it hinders the success actually of maybe some of the impact companies that you are referring to. It matters that if you don't get these women building bigger companies, it hinders their success if they don't become the investors that you want them to be for the future generation. So it has a bit of a long, it's not only for the entrepreneurs themselves, but it has a longer term consequence. And it means actually for the investment community that they miss a lot of opportunities to get, because they don't get the pipeline. They're not in those networks, and that means that it's also an economic reason why we should solve this. Larger deal flow means that VCs can pick more companies. And more and more studies say that if you pick companies where there is a woman on the team, that actually the economic return is higher. So there is, in that respect, there is also a need to change that. How can we fix it? How did we fix it at the Next Women? Did we have a secret master plan? I don't know. I got this secret master plan from Tesla because they say we have a secret master plan and they have this 1, 2, 3, and I thought, that's a good thing. What we did 7 years ago, we started to build networks. We started to, with a lot of pitch competition, putting women, female founders in front of investors. Even though they didn't have a plan where investors would invest in, we actually gave them the opportunity to at least understand the way in how the metrics work in the VC funding. So are you able to build a company which requires angel or VC funding? So we had a step-by-step approach there. We built a huge community. It was very much event-based to get these contacts because it's a lack of contacts, lack of network. So that's why we thought about, we're talking about a lot of digital solutions here, but in the end, angel funding and VC funding is very much about getting those people in front of you and getting to know those investors. Most investors invest only in this small circle around them. I think it's 80 kilometers in their vicinity, and because they want to understand the business a bit longer. And in that respect, it's very different than crowdfunding. We set up a step plan where we did a lot of mentoring, a lot of experts to help those support those women with their business plan. So that was actually the first thing we did in the last couple of years, and we built a huge network, basically in Europe. We started also in Tunisia, afterwards we said 3 years ago, one of the biggest problems is as well that there are so very few female investors. So we need to do something about that. And we set up a fund with successful entrepreneurs who had built companies or who either had sold their companies. And it is a small pilot fund which we piloted 3 years ago. There are 60 female investors investing in a fund, and we invest that further into these starters, and we make a sort of a community around these women. It's almost like an accelerator geared towards women. And we see that those female starters who are taking risks. These are not nail shops. These are technology platforms or risk-taking companies where it takes sometimes a long time to get break even. And we see that it really supports those women into the further VC community later on. So we made about 25 investments. We had a big problem with the regulation because they don't know how to deal with these with this special fund, because it's a fund where the ticket to get into the fund is below 100,000, and then in the Netherlands at least the banking system has big difficulties with regulating that. So that has been an ongoing discussion, and it's actually too expensive to hold this discussion with the bank for us, with the regulations to us. If you set up something as small as a 1 million fund, actually it's very hard to also be able to pay for the regulations in that respect. So that's the second thing we did. The third thing is something that we think we should really do now. We have this pilot fund, it's a success, and we need to grow it into a much larger fund. What we see is that we've grown about 10 companies who are now busy with their further funding rounds, and we as a female community cannot participate. As you know, only 7% of women are in those larger venture funds. So we think that we should now be in those. We need to have a fund ourselves, and that is something that we are in the process of. We are fundraising for a much larger fund, so that we can follow on the success, and then be able to transform really this broken system. Let me tell you a little bit about this fund and also why now in Europe. The fund that we want to have is typically something which would go into marketplaces, healthcare, and financial services. These are the industries that we see our women going into. There's a lot of fintech. We hold a big pitch competition last year, and of our finalists, one was into underwear for urine, how you would say that, loss. One was into female condoms, and one was into breast. It's really true. One was into a breast. Solution for cancer, and there was a fashion finalist. And people said, wow, this is very women-oriented. And I said, well, there were 150 companies, but still this is what women come up to. These are solutions close to their heart, and that is probably where it's very hard to get that funded because, well, you understand how that works. When you have a solution like that, and you have to go in front of a VC fund with those type of problems, no one will understand there. So we will leverage our unique deal flow going on, and the fund should be something like 30 to 50. Let me end this. This is the ecosystem supporting women-led companies. So on the left side, you have the accelerators and the networks which are geared towards women. On the second, these are the accelerators and the angel groups for female investors. And then you have a couple of small funds, and on the right side, you see some of the female-focused funds which are there. So you see there is a large system supporting women-led companies. And this is the ecosystem in Europe supporting female entrepreneurs. All the others that you've seen in the previous slide are in the US. The US has seen that this is an issue, and you see that the programs and the funds that they have developed have really made a difference in the percentage of women who are funded, in the percentage of women who are investing, and it really has changed is changing the ecosystem in the US. And in Europe, we are actually we don't see this as an issue. And if you see the numbers, it is an issue. So with that,
well, just one question on that. I mean, how do you account for the great difference between the US and the European approach? I mean, what do you think? What do you think is behind it?
What I see is the same as the whole. A lot of things which start in which we develop have been developed in the US a bit earlier. And I think this is something we can fix ourselves. We don't have to wait for all these funds of accelerators to come to Europe. I mean, this is the same as the exit markets. I set up a company an internet company, and we sold it to a US company because, you know, they were much earlier in understanding that they wanted to buy internet companies with a large market share. And we depend a lot on the US. We look to the US. We want to build a Silicon Valley system, but we don't have to do that. But if you see this, that's actually... so on the left side, there is an UK fund which just raised some money. Carmine is a private equity fund funded by the EIF. And it's us. And then you have, of course, a lot of women's networks, but that's very different than be focused on capital and on finance. So, yeah.
Well, thank you. We better move on. And you're next. I haven't got your name. Yes, it's Elwin.
Okay, thank you very much for being here. I will try to present you a modern way of microfinance. That's I might ask for. We are a relatively young microfinance institution in Europe. And we started in 2009 in Holland. And what I like at microfinance is it's about financial inclusion. It's about giving people trust, giving people money in order to stabilize their lives. But what I don't like in microfinance is it's really traditional. So there are not that many investments from IT normally in microfinance. What I like at fintech is that it's very much involved in IT. But at the other hand, if you look at pure fintech, they are more focusing on existing customers because there is a lot of data available for them. And they exclude, at the other hand, a lot of startups and a lot of people. So what I tried to do when I founded Credits in 2009 is to combine fintech and the traditional microfinance in order to help startups with their company, but also use the maximum of IT we can possibly use in order to lower our handling costs. Okay, I had prepared some slides. The green button doesn't respond. Maybe you're tired of slides and it's not working. Okay, without slides. What I said before, I started Credits in 2009. We are a private organization. We are, like many microfinance institutions, not for profit. It's very important, and we have a very broad funding base. So we attract money from 15 insurance companies and banks in Holland. We attract money from the government. The government's very much involved, of course. We needed them. We also attract money from the EIB. We are the first microfinance institution in Europe who attract 100 million euros loan from the EIB. And we are supported by grants from the European Commission, serviced by the European Investment Funds. So we have specialized guarantees from EIF for our microfinance program, and it's very much needed. We are absolutely practical. So we have one back office location in Holland. So there were working 50 people. That's a little bank. And we have 20 loan offices in the country, and they are servicing our customers. They visit many customers at home, or have Skype calls with those customers if you are if you are rated as a green customer. I come to that back later. So we are working on different credit programs. So we have microfinance, of course. We define microfinance a loan up to €50,000, especially for starters. So 70% of these microloans are provided to startup companies. And we have also SME loans up to €250,000. We have flexible credit, we have leasing, we have mortgages, all kinds of credit products. And our interest rate is relatively low. It's from 6 to 8%, and that's for microfinance institution low. We also developed a credit score system. So every application is coming in via the websites and is enriched with a lot of data, external data and data from our own portfolio. And based on these data, we determine the risk of the application. So it's green, orange, or red. If you are green, then you can choose for a short process. So you can have a Skype call, and if you are green, you can have a loan, a microloan, within 48 hours. But if you are orange or red, then we have to visit you at home, so then it's more traditional. So we are using IT in order to process our applications. We get more than 50 applications a day, and that's quite big. And we provided more than 10,000 loans in the last 8 years for more than 220 million euros. And we can process that many applications because we are using IT very well. It's really a pity that you can't see my slides. These are beautiful. I didn't send them. Really? So it's my fault. Oh no. Okay. I can send you all my slides if you are interested. Okay, BDS. BDS is a very important thing for microfinance institution, business development services, in order to help people to set up their business plan. Normally, a microfinance institution are using coaching and mentoring as a very popular instrument to help people, and I think that it's very valuable. On the other hand, e-learnings can be very helpful as well. So we designed a lot of e-learnings for our customers in order to write your business plan, write a marketing plan, how do you recollect your money from your customer. All kind of e-learnings that can be very helpful. And I think what's very interesting is we charge our BDS. So we do this at two reasons. First of all, to get some revenues from BDS in order to invest in new, innovative BDS services. And the other hand, I think our customers have to know that if you offer professional services, you have to pay. So if you go to your accountant, then it's not for free. If you want to buy a coach, it's not for free. If you want to buy an e-learning, it's not for free. So these are not market prices we charge. It's just €200 for a 1-year coaching, but it really helps us to get our business model very well organized. So one of the goals when we started Credit is we should be sustainable within 3 years. We should working very close together with banks, because we convince the banks that we solve their problems, and that's what we do. Because if we provide a loan to a startup, then the company has to go to the bank, open a bank account, and the bank can offer them a lot of other services like payments, insurance, etc. So we helped the banks in order to provide loans they want to provide and give them new customers back. So the banks in Holland refer a lot of applications to credits. And I think that's one of our main success. So for example, ING, they don't provide any loans to startups under the 50,000 euro anymore. They refer all these applications to our websites and to credits. That's very helpful. Now, we are 8 years operating. We are sustainable. We make a profit of more than 500, 600,000 euro a year. We think we use fintech elements in our microfinance model in a very proper way. And we have a different kind of BDS. And if you use these elements, these modern elements in your microfinance model, I'm pretty sure that we can moving ahead as a sector, and we can also bridge the gap between the traditional microfinance and the very sophisticated fintech, and it will help to make microfinance as a sector much more sustainable.
Okay, since we're running a bit short of time, and since the topics are very similar, Samuel, if you'd like to give yours, and then we'll go from there.
And if you want, I would want, first of all, to correct something. Maybe I think the flowers are more on your side, basically, like just. So basically, so my name is Samuel Claus. I came here today with one objective and one question, basically. So the objective is in a couple of minutes maybe to talk about what EIF is doing in inclusive finance. I'm here with colleagues from the EIB, EIB Institute, from the European Commission, because we are also colleagues, and I name Ricardo, so we are in the same team at EIF. So my first objective is to explain to you in a nutshell what are the products we have today. And then I've got a question, which is, it's very interesting today to see that we talk about fintechs in a very mature sector, which is microfinance and social enterprise finance for what we are doing. And my question is, what can we do together next? What can you bring to us and what we can bring to you? In particular for the value chain and how to shift it differently maybe. But for the objective, I've got a couple of slides. For the question, I will be yours later on. So EIF, it's the European Investment Fund. We are part of EIB. And I just wanted to make a focus on this team called Inclusive Finance Team. So you have been working with us, and we provide a couple of products that I will describe, but the way we work, we have resources from the mandators, so mainly the European Commission and the European Investment Bank. So I've got a colleague from the Commission, it's DG Employment, and the EIB, which is our mother company, is also providing funds. So that's what you've got on the left-hand side of that slide. And with whom we work, that's probably the message of that slide. We can work with all type of organization, whatever the legal form, whatever the status, if it's a startup, if it's a developing or mature organization. So in practice, there is no obstacle from the legal side so that we can start talking on the legal standpoint. So we have been working, for example, with cooperatives, with NGOs, with banks. I mean, the list is long. There is no limitation. And interestingly, what counts for us is that ultimately these organizations would serve the micro enterprises or the social enterprises. So we have a bit two topics which come from the Commission and EIB. The micro enterprises, it's mainly the question of access to finance for people that want to develop a business and that cannot access the regular offer. And social enterprises, it's a bit of a newer topic for social, the social enterprises space, obviously, as the name says. Okay, so it doesn't read very correctly, but here what you should retain is that for the microfinance side we have the EU definition. Okay, I really don't make it well. Sorry for that. So microfinance, as you probably all know, it's the companies that have less than 10 employees, less than 2 million of turnover or assets, and that receive a loan of less up to 25,000 euros. So this is the, let's say, the classical definition that obviously you have amended in a good way in your case, for example, but that's what we can use as an operating ground for EIF. And then what we launched, thanks to the Commission in 2015, was the social enterprises support. And for us, social enterprise, I could get into more details, but it has a part of the profit that goes to the social mission. It's demonstrated mainly through a declaration that we have put in place. And it's a company that has less than 30 million of turnover, regardless the number of employees. So, but what you should retain is that there we can talk already. If you operate in one of these two areas, we have potentially something to say already. Product-wise, so here it's a mix of what is existing, what will exist. We have a guarantee that is operating for the microfinance. You are benefiting with credits from this mechanism. And we have another part which is the social enterprise guarantee. So we can take the first lots piece free of charge. So that's a budget allocation basically that we do. Then there is the capacity building, which is also interesting to mention because it's one way to make equity investment or sub-loan investment into new companies that provide microfinance loans, microloans or social enterprise loans. And this is also, we have been approached already quite a number of times by crowdfunding platforms, or let's say fintech companies operating in our domain of activity. So that's probably where we see the closest link with today. And then the last piece should be operating soon. Luckily, it's the funded instrument part, so it's basically the lending part. So we can finance the loan portfolio with this easy funded instrument, as we call it. So the name you should recall, when I was stating my objective, it's that we have this easy instrument with a guarantee fold, an equity part, and a lending part for the portfolio. And to finish, maybe I wanted to show what we have done so far. So we are active. This is the guarantee status. The figures are a little bit outdated, but we have been working through quite a number of countries in Europe with a large variety of institutions. So we are quite adaptable, in fact. And that's a bit the interesting part today, as I wanted to say, is how we can go further together and improve the offer, thanks to the Commission help also. So that's my part.
Okay, that's great. It's I mean, it's interesting that the European Commission and its various institutions are getting more into microfinance, particularly in the context of after 2008 and I've seen that they've been trying to do a lot of issues. There's a lot of money going into North Africa and Greece in particular. I wonder to what extent they're making a net contribution, and because if you look at the figures for the failure rates of micro enterprises, they're really, really astonishing because everybody is getting poor. There's no demand. So exactly what is created by setting up new types of micro enterprises when demand is collapsing, I'm a little bit skeptical about. But are there any, for all of the participants, are there any questions, burning questions on what we've said so far, and particularly the way that fintech can certainly help? I mean, we've heard that the way that microfinance is made more efficient through the fintech applications and algorithms and things like that, they can really reduce the risk. That's one thing that always interests me, that, you know, the sort of businesses, they're not willing to take a risk with some of the best businesses, which don't always look very good at the start, but they should really pile in. And I'm wondering whether they're able to filter those particular businesses out and just stick with the banker businesses. But that's another issue. But anybody got any questions that they would like, or a comment to make on the issue of the cooperative side, or the social venture capital, or the microfinance? Anybody with anything on that? Okay, I was told that we should leave some time at the end for questions because there was burning interest. There's one up there. Okay, sorry, coming to the light, yes. Can't see a thing. Okay.
I would like to ask my question with regard to microfinance. What is the rating of the finance or the investment? Does it take more into consideration the social multiplier effect or the viability?
I think the question is about how do they rate the lending? Is it on social on financial viability of the micro enterprise, or on social, the sort of multiplier effects? Was that right?
I mean the degree. Whether is it more on viability, or is it more on the social multiplier effect?
I think it's more on the social part. I don't understand it maybe not correctly, but we rate our customers, and especially the startups. Of course, we needed a business plan, so we are rating the whole application based on the content of the business plan. But on the other hand, we are also focusing on the social impact. So if we can create more social impact, then we can give people the benefit of the doubt. So that's the way how we assess a lot of applications. And we as a company are rated for sustainability, of course. So if you look to our funders, then they focus on credits. Is this organization sustainable? Is it organization value to give a loan of maybe 100 million euros? But on the other hand, especially for the European organizations like EIF, they are focusing much more on the social impact. So how many jobs are created? How many people are coming from unemployment, for example, and not on benefits anymore? So it's both. It's the economic value, and it's also the social impact.
Well, on that, I mean, we haven't got that much. Oh, is there another question? Yes.
I actually have a question to Gert. I wonder, just if we would like this concept of the economy for common good to go to scale, do you have any examples that actually regulators, policymakers actually consider introducing this sort of a framework, just in their countries? Or do you have any conversations with regulators, policymakers?
Yeah. On the European level, there is one institution whose exact name I don't quite remember right now, but this is kind of an institution of the European Union that takes on board initiatives from society. And that institution has had a session where they deliberated on the economy for the common good, and they have decided with a majority of 80% of the votes that yes, the contribution and the ethical approach to the economy should be integrated into European legal frameworks. But that is as well as an empty promise if it is not backed up by societal pressure and activity. So I would say, yes, we have the awareness of some European institutions, but since what we suggest, which is the kind of turning around the philosophy of business, not only looking at profits, but also very importantly, understand and accept what a company does contribute to the well-being of all their stakeholders. So that is quite a change. So that is why I believe we really need to create strong influence or lobbying or pressure from behalf of from the side of companies who really want to emphasize a different economic paradigm. So I think this is not a given. We cannot wait for European institutions to come to the party, but we need to invite entrepreneurs to push those buttons and to create an economy for the common good.
I apologize, I'm keeping you from the lunch. Just two quick questions, actually, since we were on the topic. And these are actually not questions, they're comments, if I may, if you allow me to do that, especially on GERD and then on the women's. And this is based on my experience, by the way. So what you presented is exactly what businesses should be doing moving forward. I mean, saving the planet, right? And end of the day, that's what the bottom line is. But having worked with businesses are profit-oriented. One of us mentioned that, and they will always be profit-oriented. So the second part, which you alluded to, I don't think you went into too much detail just now when you were answering the question, is that there has to be some sort of influence on these businesses to do or to go social or to comply to CSR. And the best way to put that pressure is the market participants should do it. So you see the ESG indexes now on funds. And we know historically also that the value of a company increases if they are complying with some social or governance or environmental standards. So there is historical data for that. So I think these are the ways which you encourage companies. There has to be something in it for the companies. And that something has to be value created in their share, in their company. It has to be a value which can be measured in dollars. And they're not going to do it for just the social responsibility. Now, some companies do it for social responsibility because it is regulated that a certain percentage of their profit should go for social. So that's a farce, I would say, again, in my experience, because they have to do it. But there is a business case for it. And we can talk about that in more detail. Some people say that the worst enemy of a woman is she herself. You probably heard that. And I think the reason when you present 5 or 10 proposals to a venture capitalist and they select the handsome men as compared to the beautiful ladies is because they have not been sensitized to gender. So again, there's a huge volume of work that needs to be done to create this awareness or the market for your products. And it's not market creation in terms of the viability of your project. It's market creation in terms of how do they evaluate a project which is presented by a lady. And I'll tell you again, this is based on experience. It's the mindset of the evaluators or the credit officers and the type of questions that they answer or they ask to a male applicant or to a female applicant, and they differ a lot. We do a lot of this. It's called gender sensitization within an institution. So I think that's something, again, you should be working on. So sensitize those people. Thank you.
Well, I think that's a good last sort of comment. Unless we have any other burning comments, I'd just like to thank the participants on the panel. I think that was stimulating. A lot of questions and issues were raised, which I'm sure we can take over the lunch and into the next session. So thank you very much.